Welcome to the Deep Dive. You've sent us a stack of sources, and we're here to extract the absolute core insights you need. Basically, a shortcut that respects your time. Today's mission, it's all about answering what is maybe the single most frustrating question for anyone starting out in currencies.
Oh yeah, the big one.
The big one. Why does the price move? I mean, if you spend any time at all looking at a chart, say USD, the immediate impression is just dizzying. It's random.
It really is. Up 20 pips, down 15.
Exactly.
Yeah.
Then a sudden spike up 10 and a quick reversal. It just feels like pure chaos. So our goal today is to take all that apparent chaos and give you the foundational logic that's sitting right underneath it. We're diving into material focused entirely on the core drivers and the critical mental shift you need to make. Okay, let's unpack this. We are looking for the forces that organize what just seems like random noise on your screen.
And it's the perfect place to start because that perception of random, minute-to-minute noise, it leads to some really damaging assumptions pretty quickly.
The brain hates randomness.
It hates it. And when it sees price going up and down without a really obvious cause, it just jumps to conclusions.
Right, that feeling that you're just watching a coin flip. Or maybe even worse, that someone is actively flipping the coin against you.
Precisely. The first false conclusion is, well, it's the easy one, that the market is completely unpredictable. Since it all looks random, the thinking goes that there's no force strong enough to really analyze.
Okay, that's one. What's the other?
The second one is a bit more corrosive. It's the idea that the market is just inherently manipulated, that these huge actors are moving price around just to hunt stops or trap retail traders like you.
But the sources we're looking at today make it really clear that neither of those is the whole story.
Not at all. That's right. Neither conclusion really holds up. The movement that looks so random is just the noise created by these vast, constant institutional money flows making, tiny adjustments.
Hedging risk, filling orders, that kind of thing.
Exactly. It looks totally random on a 1-minute chart, but the underlying direction that's driven by powerful identifiable forces. And once you understand those, the chaos just dissolves. It turns into something you can logically interpret.
I think we had to push back a bit on that manipulation point, though, because it's so pervasive, right? I mean, if we agree that the big institutional players are driving the price with trillions of dollars, doesn't that just kind of prove the manipulation theory? Only now it's centralized, it's legal, and it's all done under the banner of, hedging.
That's a really fair challenge, and it gets to the heart of it. It's not manipulation in the sense of, like, some shadowy figure pushing a button to steal your $10. It's better to think of it as collective positioning. These huge institutions aren't colluding to specifically hurt you. They are just executing massive transactions based on a forward-looking strategy.
So it's a byproduct.
It's the byproduct of necessity, not malice. They have to buy or sell to manage risk, and when enough of them agree on a direction, their actions create the movement you see.
That makes it sound so much more objective, which is, I guess, a key mental shift right there. So if we've established that institutional positioning is the cause, what's the single most important principle driving it? Here's where it gets really interesting.
The foundational principle, the absolute core insight from all your material is this. Price moves not because of current facts, but because of changing expectations about future facts.
A giant anticipation machine.
That's the perfect way to put it, yes. The currency market is a giant anticipation machine.
Lay that out for us. Give us a concrete example.
Sure. Think about employment data. If the U.S. unemployment rate is reported at, say, 4.0%, the market doesn't move just because 4.0% is a fact.
Right.
It moves based on what that 4.0% tells the collective market about what the rate might be in 6 months. Or, even more importantly, what the Federal Reserve might do with interest rates next month because of it. The data is just a catalyst.
A catalyst for reassessing the future. So the price you see on the screen at any given moment is the running consensus of what the future value should be.
Exactly. And the big players are constantly reassessing 5 key areas to form those expectations. If you want to know the gears driving this whole thing, these are them.
Okay, what are they?
First, future central bank interest rate policies. Are they talking about hikes or cuts?
Yeah.
Second, the direction of inflation. Is it trending higher or lower than everyone thought? Third, the pace of economic growth. Is the economy speeding up or slowing down?
Okay, so those first 3 are very specific to a single country's economy. But currencies exist in a global context.
They do, and that brings us to the next 2, which are broader. Number 4 is political stability and geopolitical threats. Instability raises risk, and risk has to be priced in. If a region looks shaky, capital leaves.
And the fifth?
And fifth, global risk sentiment. This is what dictates global capital flow on a huge scale.
Let's define that one a bit more. What does risk sentiment actually look like in terms of money moving around?
It's actually the simplest way to understand why certain currencies tend to move together. When sentiment is risk-on, meaning the world feels stable, growth looks good, money flows out of safe haven currencies.
Like the Japanese yen or the US dollar.
Exactly, the JPY or the USD. And it moves into currencies that are sensitive to growth, like the Australian dollar or the New Zealand dollar. People are looking for higher returns.
Seeking yield.
Right. Then, when sentiment shifts to risk off, maybe there's a crisis or fear of recession, that capital just reverses course. Traders pull cash out of those growth assets and flood back into the safety of the USD, the yen, or the Swiss franc.
Because safety becomes more important than yield.
Priority number one. And that flow, that massive flow of capital driven by shifting expectations across those 5 areas, that is what creates every single movement you see on your chart.
That is a much, much deeper way of looking at it. So the moves aren't random. They're the shadow of trillions of dollars reacting to a consensus view of the future. But this leads us straight into what you call the timing paradox.
The most confusing thing for a beginner.
It's infuriating. So you've prepared for a major U.S. news release, let's say non-farm payrolls, at 8:30 a.m. Eastern. But you see the Euro-USD pair has already dropped 50 pips between, say, 7.30 and 8.25 a.m.
Yeah.
Then, when the strong data actually comes out at 8:30, the price barely moves. Or worse, it reverses a little bit. It's maddening. Why did it move before the news?
Because the market doesn't wait. It's that anticipation machine we were talking about. This is the concept of something being priced in.
Okay.
In the hours, even days leading up to a big release, institutional analysts have already built their models, run surveys, and they've positioned billions of dollars based on what they expect the data to show. They form a collective forecast.
So the consensus is that the employment numbers will be really strong, which is good for the U.S. dollar traders. Start buying the dollar well in advance of that 8.30 release.
Right, and that early buying is what causes the 50 pip drop you saw before the news even happened.
So by the time the clock actually hits 8.30,
By 8.30, most of the people who believed the numbers would be strong are already in the trade. They're positioned. So if the news then comes out and it matches their expectations, well, there's no need for a big adjustment. The price was already reflecting that outcome.
and what if the news is completely different? A total surprise.
That's when you see the fireworks. If the news surprises, if it's way weaker or way stronger than the consensus, then the market has to rapidly correct itself. That violent price move you see right after the release, that is the sound of the market realizing its expectations were wrong and adjusting instantly.
This is so critical. It explains why trying to trade the news right at 8:30 is so difficult. You aren't trading the data. You're trading the surprise factor.
You're betting on the difference between the actual data and what everyone else thought it was going to be.
But wait, this brings up a tough question. If the market always moves based on expectations, and those expectations are mostly invisible, I mean, they're locked away on institutional trading desks, how can a beginner ever know what's priced in? Doesn't this just mean the house always wins?
That is a great question, and it really shifts us into where you should be focusing. You're right, a retail trader can't get those consensus reports. But the price chart itself, that is the public record of those expectations being acted upon. The way you read the market's expectation isn't by trying to be a fundamental analyst, it's by observing the price action before the event. If price has been moving strongly in one direction ahead of the news, you can infer a strong consensus has already been priced in.
So the job of a technical analyst, which is where most beginners start, is to chart the effect of those expectations.
You got it. That's the link. And this objective understanding leads us right into the mental shift we need to make. Knowing the market is governed by these vast impersonal forces has this huge emotional payoff.
It takes the personal sting out of it.
It absolutely does. It removes the heaviest emotional weight you carry as a beginner, that feeling of being personally victimized. When a trade goes against you, it's not because the market knew you were there. That feeling of unfairness is what kills trading careers.
That victim mentality. It leads straight to revenge trading, doubling down on losers.
All the destructive behaviors.
Yeah.
The ability to make this mental shift is It's just foundational. When price moves against you, it's because the collective expectations shifted based on new data, or a central banker said something unexpected. These forces exist completely independent of you. They're the physics of the system.
So you have to change your internal monologue.
You have to. You shift from that corrosive question, why is this happening to me, to the objective statement, price is reacting to a shift in belief about the future. That objectivity is everything. It lets you analyze your strategy without the interference of fear or self-pity.
That's what makes the process sustainable.
Oh,
Okay, so we've got the mechanics and the mindset. So what does this all mean for you, the learner, right now? What do you need to focus on today, and what can you consciously ignore?
it's a really crucial distinction to make. At this stage, your scope should be tight. You do not need to try and do the complex job of a professional fundamental
So
analyst.
don't try to analyze raw inflation data yourself.
No. Don't try to predict what the central bank is going to do next month. And you certainly don't need to forecast complex geopolitical outcomes.
But why not? Isn't that the point of a deep dive?
It is, but those are advanced skills. They're built on deep expertise and access to information you just don't have. For a beginner, trying to process that is just paralyzing. It's a distraction from the core goal, which is learning to read the price action and manage your risk.
Okay, so what is the mission right now?
Your mission right now is to just internalize that core principle. Price movement is a reaction to changing expectations. It's not random chaos, that's it. That understanding is enough to validate your technical analysis.
In other words, you study the chart patterns, the indicators, all the visible effects of the movement.
Yes.
But you do it with the confidence that there's always a powerful, logical reason why those effects are happening.
Exactly. You are trusting that the price always has a reason, even if that reason isn't visible to you yet. And that trust is what lets you stick to your rules and build discipline. It's the difference between feeling like you're fighting the waves and realizing you're just observing the tide.
Well, that brings us to the end of a really insightful deep dive. We've gone from the illusion of randomness to understanding the predictive power of changing expectations. We hit the timing paradox, and we established the mental shift you need for emotional stability.
I think the key takeaway is just realizing that every single tick you see on your chart is a global consensus updating its view of the future. You're watching the world reevaluate risk and reward in real time.
Which leaves us with a final provocative thought for you to consider. If institutions spent all this time and money trying to anticipate news and price it in ahead of time, how often does a true fundamental consensus-breaking surprise actually get delivered?
And if those surprises are rare, what does that imply about the stability and maybe even the predictability of the market's collective opinion?
That's the question. So keep observing your charts, but look at them now through the lens of future expectations, the reason, not the chaos.
Happy learning.